Hi, everyone. Welcome to the 143rd episode of the Timing Research Show for June 26th, 2017. My name is David Kosmeter, and I'm the creator of Timing Research. Today, we will be discussing the 196th weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com, and you can download this or any of the past reports there. I have Dave Landry back to host today, so I'm going to go ahead and turn it over to him.
Kosmeter, and thank you to Timing Research for having me back once again. Neil is supposed to join us, but he may not be here for a little while, so we'll get started without him. Jim, let's go to you first. Jim Kenney, veteran of the show. For those of us who don't know you, tell us a little bit about yourself and tell us a little bit about OptionProfessor.com.
Sure. Well, with OptionProfessor.com, I provide all the content to the DVDs. They have 7 DVDs, and basically it's a situation where we go over the basics, intermediate, and advanced strategies. So whatever level you're at, the DVDs can definitely come in handy, going over things like bringing cash flow in with writing strategies like credit spread, covered calls, things like that. Or you can also go into hedging strategies like collars or married puts. And then, of course, you have your speculative strategies where you can do limited risk calls or puts or combine them with strangles and straddles. And then, of course, discussing how to roll them or calendar spreads and many other things as well. So real good reference point for everybody out there who wants to try to, be more knowledgeable about the uses and risks of options.
Cool. As I often say, a lot of moving parts with options, so you need as much education as you can get. All right. Good job, Jim. Michael Filighera of LogicalSignals.com. Michael's another veteran of the show. He's been here many times. But for those of us who don't know you, Michael, tell us a little bit about yourself, a little bit about LogicalSignals.com.
Again, I'm Michael Filighera, and I am the owner, starter, founder of LogicalSignals.com. And what we do, or what I do, is I operate a trade room. And through Logical Signals, which I'm in the process of revamping and relocating, difficulty with outside hackers of all things. So I'm moving the website, and then I'm going to vamp it up a little bit, because what I provide on the website is daily updates on market activity, on basically the markets where we trade or where I trade. And we focus on day trading. We focus on very short-term moves. I have a couple of algorithms that I use that are auto traders, and so I've been refining those and beefing those up and making them a little bit smarter. And so I also offer coaching and to help new traders or traders that are trying to regain success in their trading. And so we work very hard on just identifying where there might be some problem areas, whether they be actual trading errors, or whether they be more emotional or emotionally based. And so we try to work through all of that and get people back to being consistently profitable. And that's the main goal.
Yeah, it's amazing how much psychology plays a role in all this. And from my experience, your attitude is much more important than your aptitude.
Good absolutely stuff. True.
For those of you who don't know me, Dave Landry here from DaveLandry.com. I have an educational-based website, DaveLandry.com, and if you're interested in learning more, you can actually go to DaveLandry.com, and I've got to shorten this, Earl, but I think it's DaveLandry.com, timing-research-special-office. I'll try to get that shortened if I get invited back someday. But on the website, you can learn a lot about trading. You don't have to spend a lot of money to get started, or spend any money to get started. In fact, I do a weekly webinar that's fairly popular. It's called Dave Landry's The Week in Charts. And you can bring your trading questions there and be happy to answer them. I do a little lecture for a little while, and then we take a look at the charts of the week and go from there. All right, Jim, let's go back to you. Question number 1 and 2 are going to be combined. What direction do you think the S&P is going to head between, I guess, this morning's open and Friday's close? And rate your confidence to your answer by estimating the probability that you have correctly predicted it. And, in the next segment, if you like, you could share charts too, if you want to elaborate on it.
Sure. Well, last week I got lucky because the market opened very strong and made a new high and everything else, and I said it would ease by the end of the week, and it did that. And so we're back up here again this morning, and I've seen some selling come into the transports off their high. And so I am going to stick with the concept that it might fade by the end of the week. A couple of reasons for that would be the VIX, like I referred to last week. In the last month, it's been under 10 times. And I think like in the last 10 years or more, it's only been under 10, 11 times. So that is the complacency meter pretty much going off the charts here. The transports opened up near 9,500. They faded already today a little bit, and they have not been able to get above 9,600. And the treasuries continue to show a lot of weakness, and durable goods orders today stunk. So, you know, people may be totally rethinking the economy, rethinking inflation. And if they rethink things, sometimes they'll take a little off the table. Now, as far as confidence level there, I'm not going to go heavy. I didn't go heavy last week with it either. So I would say it's probably 50-50 because seasonally, the week before July 4th and the week after can be decent for stocks. And people are very hesitant to get out of stocks because they have all these carrots down the street. And the carrots are infrastructure. The carrots are tax cuts, the repatriation carrot, deregulation. A lot of carrots, but it's starting to look a little bit to me like the dog who chases the rabbit down at the track. Got a lot of people chasing that rabbit. And as far as I can see, I don't see anybody getting it.
I gotcha. Good analogies there. All right, Michael, same question to you.
I'm going to fall directly in line here, and I also think that it's like, yeah, I see what the market's doing this morning, and I, of course, read the report from Timing Research, and I actually don't disagree. I think I'm with Jim. I think that the market will fade, will continue to move lower, and I don't want to echo the responses already given as to why the market. I will only add that what could possibly be in favor, because I also see the carrots hanging out there. We have the end of the second quarter, and so we're going to have to start pushing back into earnings reports. And I know a lot of them are kind of looking at some more positive aspects that could be coming out from that. But one thing I did notice this morning in the selling is that the market seems to now going back for the financials. So they're going after the banks and they're buying up the banks. And I suppose they're doing that on the heels of that the bonds are continuing to move higher, which is kind of giving an indication that rates are supposedly going to ease a little bit. I don't see that happening. So I think that is definitely a crowd of dogs running around the track chasing the carrot or the plastic dog or whatever they use there. A plastic rabbit, excuse me. I feel pretty strongly that it's like that starts to even out, because I also saw this morning that a lot of, I don't know how big the orders are, but they're starting to sell tech stocks again. So the last time we saw that, it really did cause a little bit of a burp in the market. And that may just last right this end of this week, maybe beginning of next, after the holiday. What we have working against us is that we don't have any volume. We're not seeing any really strong volume in either direction. And so we're kind of left to algorithms. And I think the algorithms that are out there, and they're just trading, and they do an option trade and they're hedging, and whatever they're trading against that, it just happens all at one time. And that has a very strong influence on the market, and it can really exaggerate a move when we're not getting the volume that come in to support that. So as long as I continue to see that, I think we have a 50-50 chance that this is fire. I'm going to sit right in the middle like Jim, because I don't think we can really lean one direction or another. I know the report really indicated that 69% or whatever, I don't know what the number was, I believe it was 69%, are really looking at a higher market. And I get why. There are a lot of carrots hanging out there. There are a lot of they're running around a track. And I think at this stage, as we start to move higher and approach those all-time highs, you know, we get a lot of people like, oh, I won't get left behind twice, or three times, or four times, whatever that number is.
Yeah.
So I'm going to go 50-50, going to sit right in the middle. And my style of trading is that I don't really care if it goes up or down. I just want to do one or the other.
Yeah.
Preferably both in the same day. That all works for me.
Gotcha. Well, I'm going to go with up, and not because I'm being contrary or anything. I've been called, and it wasn't very nice at the time, a trend following moron, and I just follow the trend. And many years ago, I tried to outsmart the market. And when I first started providing web-based commentary back in the 90s, I'm dating myself, I tried to predict every zig and zag, and quickly I realized that I was going to end up chasing my own tail, and I should just follow along. And I started drawing big blue arrows on the chart, and I got known for that. And somebody told me where to stick them once. They were heavily short and very leveraged, and they didn't like the fact that my arrow was pointing the other way. Anyway, so I'm going to go up, and I'm going to go 70%. Before, I've said before that you could only predict short term when it comes to markets, and many people have misconstrued that as you could always predict short term. And that's simply not true. If I have a nice pullback, or what I call a trend knockout, which we had in the NASDAQ recently, and I'll show you that pattern in the next segment, then I could say with a fair degree of confidence that I know what direction the market's likely to head. And it could always do whatever it wants, obviously. But you can't always predict, and I think it's tough, especially in an index that's a little bit more efficient than an individual issue. And I'll flesh that out in a minute. Jim, next question is, for your answer, please share what specific reasons you think the S&P is headed lower. And if you would like, feel free to elaborate by sharing your charts on that.
Yeah, well, I just wanted to say, you know, some of you guys might be a little bit sharper than me on the Fibonacci numbers, but somewhere I read that this 2560 area is kind of an important Fibonacci number that it hit last week. Do you guys have any input on that, or?
Is that the number in and of itself? Is that the square root of 0.61? It might be the square root of 0.618. If somebody has a calculator with square root, oh, I got one right here. Let's see, 0.618. Square root of 0.618 is 2485. And I never did understand why you have a number that's supposed to be magical, and then you take the square root of it, and that's magical too. So.
Yeah, anyway, that's not a heavy part of it. I just thought if you guys were more proficient at it than me. At any rate, that was one factor that I thought was interesting last week when it hit that and then backed off. But here's the more important things. You know, with regards to this week, you know, we've got a lot of stuff coming out this week that might be interesting for people to keep an eye on. Durable goods came out minus 1.1%. It was supposed to be an up number. And obviously that's not an economic stronghold. Then today we also had Chicago Federal Reserve come out, and they said economic activity retreated in May, and due to a sharp deceleration in production, employment, and housing activities. So, you know, the numbers that are coming out have not exactly been robust. Now, later in the week, we have oil information coming out on Wednesday, EIA oil status, and on Friday, Baker Hughes rig count. I don't know if that's going to put more pressure on oil or not. Consumer, though, we got Tuesday, Thursday, jobs, also Friday, sentiment, and personal income and outlays. So you got some stuff happening with the consumer. Housing, you've got mortgage apps on Wednesday and pending home sales as well. So you get a little bit more action there. And then corporate profits is coming out on Thursday. Last reading was 12% positive. So there's enough meat on the bone this week for people to chew. But I'll tell you, I've seen the market for a long time. There's got to be a reason why this stuff just is very stubbornly higher. And like a lot of guys say, it doesn't stay near the highs this long. If it's really a high point, it generally keeps grinding higher. So you have to respect that it could keep grinding higher. And I think the anticipation, well, first of all, the passive investing. We're like 50, 60, 70% passive investors now, which means people buy stuff and then they go to bed. Now that's number one. Number two is that
that'll work until they don't.
Well, that's right. I mean, when those fangs jump, you'll have a nice black eye on passive investing. But here's the deal. You've got enough jabber down there in Washington about how all these fantastically lovely things are going to happen. And a lot of them have to do with leverage loans. They're going to release, they're going to relieve a lot of regulations on that, or not regulations, but how they interpret them. So in other words, they haven't really been able to go through Congress and change a lot of stuff, but they have different umpires now. And the different umpires are calling the game a lot different on Dodd-Frank, on the Volcker rule, on leverage lending. And somebody on Bloomberg said something about it could free up $2 trillion on the bank statements. And obviously, we just had a big meeting with Goldman Sachs, their second annual down in California, and it was all on leverage lending. And last year, there was a 40% drop in deals over 20 billion. So obviously, these guys are probably getting together out there and planning on a lot of leveraged lending and a lot of LBOs coming up. And then, of course, like I say, you got the tax cut and the tax repatriation. That's a ton of money that could come in. And so the passive investor is going nowhere. And the active investor, he gets a couple of ticks here and there, but he's not making much action up or down either. It's real, and that's why the VIX is under 10 for 10 times in a row, because we are just waiting for this fantastic onslaught of activity. Because the activity they're announcing here, inflation is tanking. And look at the commodities. I mean, they hit the grains on Friday. They hit the gold today. There's some obviously deflation going on out there. And the yield curve is inverted already in China, and trying to do it here. So that's why it's kind of binary. And we could easily go up towards 2,600 if they start discounting 2018 earnings, and it looks like all this stuff's going to come through. And we could easily go down to 2,200 if people start drinking coffee rather than what they're selling for drinks down in Washington.
What's interesting is the dollar has been generally weak for, well, let's just say all of 2017 as a general statement has trended lower, not in a straight line, but commodities have gone lower too. And that's I
think the dollar, Dave, the dollar index 96, 98 or 97 to 100, in my view, if you break 95 on the dollar, now I'll hear dollar's weak. Yeah. If it stays meandering here, I would just say dollar is stable to losing some traction. But if you got under 95 on the dollar index, there's no dispute that we've got to fall ahead now.
Right. And then what's interesting is if you read your intra-market technical analysis primers, you'll see that dollar weak meets strong commodities, and the commodities are headed lower in spite of the dollar. So that signifies that something's wrong, and maybe you've fleshed that out, and it's an inflation thing or deflation thing, I suppose.
Well, every time Amazon gets into an industry, the margins go out the window. So,
yeah, they just bought whole paycheck, I heard. Michael, let's go to you for your answer to number one. What specific reasons do you think the S&P is headed lower?
I think, a specific reason I think is a very difficult one to come up because there are just too many to choose from. I think when we're really trying to build a more positive case based on what we've done in the past, I think we start to get ourselves into trouble. I think that yes, the market could continue higher. I think that when we start to see the Dow counter to what the base of the market or the balance of the market may be doing, Nasdaq's heading lower, the Dow heads higher. If we look at specifics, we can definitely see why, and that all really again falls into what Jim has already discussed, and so I don't want to kind of go back and start repeating there. But I do believe that although we have a lot of people that are going to follow market, and in terms of what Washington may or may not be doing, I think that I would not hang my hat on that, and I don't necessarily agree with even trading accordingly. I think that the current atmosphere in Washington is not bullish, and that a lot of the stuff that comes out is them trying to stimulate, a more bullish attitude. So I tend to try to stay away from that. I don't see the Fed starting to relax. I don't see the Fed really buying into inflation, deflation, although I do agree with what's already been said. So I think that we're going to continue to see interest rates tick up. I think that'll eventually turn the bonds sour again. I think we have a lot of political situations internationally, globally, that can have a very dire effect on the market. And again, it would just be a matter of when it happened or how it happened or what happened to determine how severe any market downturn can be. I think that we are also combating the possibility that earnings are going to really start to come out in line or higher, and we might get a couple of surprises, which really would then just boost continuing to buy the market.
And with bonds headed higher now, you think that trend's coming to an end soon, or?
I think that trend is just on a hope, a whim, and a prayer. So yeah, I do actually see that. And what I'm finding very interesting is particularly today, just to pass on what they believe happened in gold this morning. It actually was overnight for us, early morning over in Europe. And I'm putting quotes around this because this is definitely not something I made up. It's just a statement made by somebody else that it was a fat finger error. Oh,
goodness.
And so 1.8 million ounces of gold suddenly hit the market.
Wow.
And in the form of 1,800 contracts to sell.
Wow.
And that's kind of a good night nurse, and down it came. Market recovered some, but now it's kind of sitting in the middle.
Yeah.
It's only down 10. It was down 20. Now it's only down 10. So it's kind of sitting itself in the middle there from where it was trading prior to this reported error occurred. But I think that gold traders are leaning more towards just paying attention to the geopolitical and socioeconomic factors that are kind of sitting out on the periphery, but are very real.
Yeah.
So I am very bullish gold and have been for a long time. But again, the style of trading that I've adopted is that we come in clean, fresh every day. And because I think that, being that we're up here at new highs, to have to constantly kind of support why becomes very tedious. I think that again, going back to before algorithms really took over the markets, there was more solid responses to news, to thoughts, to all of the economic figures that we have coming this week. And now we might get them, but they're computer generated and they're based on somebody else's thoughts of what should happen. So we're seeing a lot of range-bound trading in terms of if we're looking at an hourly or a daily chart. And these moves that are happening are providing opportunity for traders that just kind of go in and just do it for the moment.
Gotcha. Without
saying that I believe that tech is going to recover. I believe the banks are going to hold up the market. As far as I'm concerned, I don't really base anything on the who, what, where, when, or why theory anymore. Again, I'm going to say what I really want. I just want them to move.
Yeah.
I don't care what direction you go in. And like I said before, I prefer both. So
if you go into a market, Michael, how long are you usually in the market? And if it's one particular market, how many trades will you make in that market in one day?
It depends on how the market is moving, but the average time in the market in a trade can be anywhere from 45 seconds to 5 minutes.
Wow. So what would be long for you? 5 minutes would be a long trade, like a long time-wise?
A long-term trade? Yes. Seriously, it's like if I'm trading and I'm watching and I'm like, okay, guys, you gave me the sell signal and now I'm sitting and I'm short. Let's go. Go ahead, do it. And then you wait and you wait and you wait. And because, of course, everything that we do is based on the algorithm, and so your buy signal is going to come when that algorithm flips. So when that algorithm indicates, higher. then it'll change. In the meantime, you sit short. And as a day trader, we can lose patience, which is why I used to want to wrap themselves around allowing an auto trader, which is based on algorithms, and our own settings. So we provide all the input as to how it should react, but then you've got to allow it to take the trade, and you have to allow it to manage the trade.
Now, is it automatically placed in an order, or you actually have to?
Oh, yeah, no, it does everything.
Okay, so you're not sitting there going. See, the one thing I'm kind of getting at in a roundabout way here. I know we're only wired for so many round trips, and you seem to be the exception to the norm when it comes to. Oh, sorry, you just got a signal.
Yes.
You seem to be the exception to the norm, but I was wondering how you have achieved that, and it sounds like part of that is through automation.
Yes, exactly. And to answer your question about round turns, that can vary because, for example, there are days in gold where you'll get a signal, and now you're in a trade, but it'll tend to just kind of, fluctuate in a $1.50, maybe $2 range. And so you're just going to sit with that short or long and wait for the market to move. That's why, as a trader and you're sitting there watching, you can become impatient.
Yes.
You can become like, oh, I don't trust this anymore. But if we're allowing an algorithm to do it, it sits. It will wait because it is not impatient. So, but if we have a market that is actually reacting to news, or just the trade itself is just heavy and moving, you can get anywhere between 25 to 50 round turns.
Wow. One more question. I'm just kind of fascinated with all this. It's if you're long, is it stop and reverse? Is it like buy signal, sell signal, or is it always in, or a lot of times you're waiting for the signal to come in?
Always, yes. The objective here, and this is something else that I believe in and what I tell new traders or traders that are coming in for coaching, I said it's what the purpose of the algorithm is so that you are participating and not anticipating. I believe anticipating tends to leave us on the sidelines. So the objective of my auto traders is that you're always in a trade. You're either always long or you're always short. Therefore, you are always participating. So
okay.
I refer to them as volatility stops because my algorithms are really take advantage of volatility. And then I add to it statistics and probabilities. And a good dose of Fibonacci, by the way.
Okay.
So on that basis, yes, you're always in a trade and you always will be participating because in all honesty, even on a day trading basis, on an intraday basis, to convincingly tell yourself, oh, we're going up and we're gonna do a $4 or $5 move. And then the market lets you know it's like, no, we're not. Because again, it's understanding that across the board, it's most larger firms, and there's a lot of HFT firms, and that's what they're still called, are active in all of our markets for the entire session. And a computer is not bullish, it's not bearish, it's reactive. So, and that's how I think that we will find a lot of success in trading, particularly when you don't want to take on the risk of carrying positions.
Gotcha. Good stuff. Yeah, I probably don't want to talk to you too much because you might shake some of the beliefs that I have about some things. But good stuff, Michael. I really appreciate that. Very fascinating.
You might find that, I think if we do talk, I think you might find that it's really great to combine.
Gotcha.
It's like it's not destroying any beliefs. It's just supporting them.
No, absolutely. Absolutely. Good stuff. As far as the market developing events or specific reasons that I have, as I said earlier, I'm sharing my screen here. This is the S&P 500. I just simply believe that we're still in an uptrend and a huge fan of moving averages. I do have one pattern that uses 3 moving averages and looks for crossovers. But as a general statement, the 50-day simple moving average can help to keep you on the right side of the market. And I usually don't plot it begins to reach an inflection point or move around a little bit. And like right now, you can see we're at 2,400 on the 50-day, which is right about the top of this base. And I did a webinar last week. Joke, it keeps the hot things hot and the cold things cold. How do we know? Well, it's a location slipping out there. But what happens with the moving averages or other techniques for that matter, they often come together at the same point. And as long as we hold 2,400 in the Ps, I'm not going to get too excited. And then obviously this big base here, so far we hold that. Now, as Jim and Michael pointed out, we're just kind of in this drift mode where a lot can go wrong. So there's always something to worry about. So I'm not going to sit around and worry about stuff too much. One thing I've learned is to err on the side of the longer-term trend. We're within 0.5% of the longer-term trend. And I haven't done the research, but I find it kind of interesting. If you go back in and look, anytime we're near that new high and how often we go on to hit new highs after nearing it, I think that would be fodder for some really interesting research. With Greg Morris, he's retired now. He was a big money manager for many years. And I learned from him that a market only spends 4% of its time at new highs. Of the time it's backing and filling. And that's kind of what's been happening with the S&P, kind of grinding higher and kind of climbing that wall of worry. The NASDAQ's a little bit different and a little bit more interesting situation. A minute ago, I talked about the knockout move we had, and that was back here. And if you look on the homepage of my website, I have an article on this that goes into a lot more details. But with a knockout move, you're looking for a market in a fairly strong trend, ideally a persistent trend, to have a sharp down thrust move. And that's going to suck in some shorts and knock out the Johnny-come-latelys, the people who bought right around these highs. They're the last in, the first out, and they can really wreak havoc on your positions as a longer-term trend follower. Had a nice little move higher. Same move happened in the Qs, so to show that it was tradable, I actually presented the Qs as a possible trade a couple of weeks ago. And then it stops out on this little knockout move that we just saw. Now, it's going to be very important in the NASDAQ for this level to hold the bottom of this knockout move. What I don't like right now is we're kind of creeping back to the old highs. And I'm not a huge fan of Fibonacci. Maybe Michael will bring me over to the dark side, but I have noticed that sometimes markets will stall out after a thrust lower, especially a sharp thrust lower. I wouldn't call this a sharp thrust, but I call it a gatekeeper pattern where it stalls at about 786 of this old high. So this is kind of a micro version of that pattern. I sure would like to see it make new highs, but for now, as a trend follower, we would continue to err on the side of longer-term trend. Now, one thing that's been difficult for us this year, we're momentum players and we play these very high beta stocks. And in spite of the market grinding higher, we've been having a hard time catching some really good trends in here. And we've got knocked out of a few of stocks that look like they were in developing trends. And part of that reason, I think, if you look no further than the Russell 2000, you could see that it hasn't made any forward progress in a long, long time. It's certainly not much to speak of. Now, of all-time high. So I'm going to continue to err on the side of the longer-term trend here too, and that's why I'm going to remain. And again, I hate to bullish my. Well, I've said it before, not again this webinar, but as I've said in the past, you got to be really careful to label yourself. But if I did have to label myself, for now, I'm going to stay bullish as long as the market is at or near these new highs. But I sure would like the Russell to get out of this range, and not to spend too much time on the sectors, but as I think. Michael and Jim pointed out, the financials are a little dubious in here. I sure would like to see them make it to new highs. I'm not a huge fan of trading in and of itself big picture technical analysis, but it does sort of, if it factors into a signal of mine or ignore it. And you can see that here we have a nice head and shoulder sort of top working there. There are a few areas that have been getting creamed in here, like retail, and some people say that that's part of the whole paycheck problem. Well, I ignore news, so I don't get too excited, but we could likely see some short setting up in retail based on this move soon. The good news is certain areas like health services banging out new highs recently, and some of these technology areas are beginning to come back. One thing that I am concerned about as far as developing events would be if the semiconductors, if I could find them, let me just punch up the SMH so I can pull it up quickly. I have another index that I follow, but SMH will work. The SMH has this knockout move that I just talked about that's in the Qs and in the NASDAQ. And you can see with this big knockout move here And it's important for these lows to hold. And so far, we really haven't made much forward progress. I do keep an eye on everything, and I do watch the transports. I know Jim was talking about the action transports. I don't get too excited about that. I factored into everything. You can see it shot higher, but came back in today. So that's something we'll keep an eye on. But more importantly, I would like to watch these high beta areas such as the semiconductors. And I'd like to see them go on and make new highs and to feel a lot better about the market if it did. So that's pretty much it. It's a little mixed out there. I think you need to pick your spots carefully. Overall, the uptrend still remains intact. But as both of you guys have already pointed out, there's always something to worry about.
Yeah.
All right. Let's go to the next. Now, by the way, if you guys have a trade you want to present this week, we'll get to that towards the end, but start thinking about that. The question of the week is, what procedures do you use to monitor and evaluate your trading results and progress over time? Jim, let's go back to you. We hadn't forgotten about you.
Well, basically, again, we don't do specific trades at Option Professor. We're educating on the strategies, and people learn the strategies and they apply them as they feel. But I would, and I did last week, I'll say the same thing I did last week, in that I don't think collar strategies or married puts or strategies that could bracket your equity would be the worst things to consider up here. Again, you know, just as my guess, if the market cannot make much progress between 2450 and 2500, then the months of August, September, and October, you know, maybe that's where some backing and filling could happen of significance. Also, you know, and this is just my opinion, you know, maybe they're not going to be able to get this tax stuff and all through unless there's some type of a crisis. And there's enough negative financial information coming out today with the Chicago Fed and with the durable goods. And then if you combine that into some gridlock, maybe they could get this market to have a correction. And then, of course, maybe they could pound the table with, if we don't do this, we're going to go into a recession, look at the yield curve inverting. And then, as has happened in the past, when people are under stress, they agree to anything. That's how you get people to allow you to print $5 trillion and buy bad loans and allow people to go down to the bank and say, I bought at a high price on my house. Not only am I not paying you back, but you're going to cut the loan and the interest rate. Have a good day.
Yeah.
You know, so I mean, things, you know, after that happened, you know, I know that everything's on the table and there are no real parameters, but I would probably like to parameter my equities if I had heavy positions in here with a lot of gain. I don't think a collar, sell a call, buy a put, do the math, do the tax consequence, do all your homework and see if that makes any sense. Or if you're up so much with the VIX this low, some of these puts are peanuts. Why not throw a few peanuts in there just in case it starts raining? Because, you know, right now the umbrellas are going for a very cheap amount. And, you know, sometimes it's better to buy those umbrellas where, you know, when they're giving them away.
Gotcha.
So, those would be my two things to look at.
Just as a side note, have you guys seen The Big Short?
Yeah.
Yes.
Movie? Excellent movie. I actually knew, not people physically in the movie, but I knew a lot of those people in the industry through my wife, whose business is somewhat related. So that was kind of fascinating. Like the stripper was like, you know, something about a mortgage, and she's like, which one? And she had four condos or something.
Well,
Jim,
one of the key players, Dave, in that was on the CNBC, and I did listen to him intently, and he was saying that there is no structural problems out there, and the leverage in the banks is very reasonable. And he did think that they were just going to change the umpires on the enforcing of the regulatory rules rather than trying to go through Congress and passing everything. And if your strike zone is now the top of your head to the ground, it's a little easier to throw strikes. So the point being is that he was very bullish on the financials on a longer term basis because he believes it's the wild, wild west ahead for them.
Oh, goodness.
Yeah.
I don't know if I asked you the question. The question was, what procedures do you use to monitor and evaluate your trading results and progress over time? Did you answer that one too? I think you might have answered more than one question there, Jim.
Yeah, I'm going to give it up to my associates out there.
All right, Michael, let's go to you. Same question. What procedures do you use to monitor and evaluate your trading results and progress over time?
Well, because I am a day trader and because I use algorithms, it's very easy to determine progress. Again, the enemy of the algorithm that I have would be a market that does not trend, sits and chops itself in a very small range. And depending on how small that range or how wide that range can be, really would determine whether I go in and turn the algorithm off. And again, the competition is other algorithms. And in all honesty, there are thousands of algorithms operating in our markets, in individual stocks, in the bonds, in all the bonds. So we're talking about notes, we're talking about 30, 10, the 5, the 2, the Euro funds, everything. They're just, and they're out there and they're operating every single minute of a trading day. And then the big guys, Goldman, JP Morgan, they just pass the book to the next desk. From us here in the United States, they just pass it west. It goes to Asia. From Asia, it goes to Europe. From Europe, it comes back to them. And so that's why it'll just roll. So to measure the results, you get it daily. You can get it hourly. We have settings in the algorithms where you can determine max profit, max drawdown on a daily basis. And when your algorithm hits either or, it shuts off. So you can really determine how you're doing, what you're doing, based on your input. Now, as far as like option trades, if we're going to really just, and I really like what Jim was saying, because we really can't determine until we kind of get a little bit further on in this whole little period that we're in. But I agree that if we don't start breaking out, then we have a tendency where the markets will just kind of sit in a range for between now and after Labor Day, almost. So we get through what we used to call the summer doldrums, et cetera, et cetera. In that period, I have always been a premium trader.
Looks like we lost Michael for a second. Still there, Michael? All right, I'll go ahead and answer the question, and then we'll come back to Michael on that. As far as the actual tracking of trades, I just use a simple Excel spreadsheet. If I punch in my stop, it will give me my initial profit target, which is based on my money management of 1-for-1 on the first half of the trade where I take initial profit. And some people might say, well, Dave doesn't have a negative expectancy. And it doesn't, because we're keeping a piece on for a longer term trend trade. But as far as the actual tracking of the trades, I use a spreadsheet. I used to have it tied to a quote feed, but I found that I sat there and I watched every tick all day, and it made me kind of nuts, or more nuts, I should say. But I just use a simple spreadsheet. I'll be happy to email anyone who wants it a copy. The hard part about trading is you can do the wrong thing and make money. The market can often be a bad teacher. You could do the right thing and lose money. And one of the things that we're seeing this year, because the market is not following through as nicely as under the surface, under the hood, as it appears on the surface, the buy and hold, or as I like to call them, the buy and hope crowd, has been rewarded for just holding on and holding on. But internally, it's been a little choppier than it might appear on the surface, especially in some of these high beta issues that we like to trade. And what could be tough is sometimes chase that performance and do the wrong thing. So as much as tracking the actual progress, I think it's also important for you to track the process. And you have to be process oriented. And obviously, the bottom line is the bottom line. Sooner or later, you do have to make money. You do have to make money consistently, or at least over the long term. And obviously, you have to control losses and all these things that we often preach of. But more importantly than anything is following the process. So I think you need to have some things, some systems in place to make sure you're actually following the process, and do a lot of introspection and do a lot of post-mortems on your trade. I like to back out every trade after I'm done and ask myself, would I have taken this trade if I were just seeing it today. And if I say yes, and even if I lost a trade, then I have to say, and I know it's tough. If you lose money, it's tough. But you have to say, well, at least I followed the process. And longer term, following the process is going to be the thing to do. Michael, you were cut off there, and I'm not sure exactly where you were. Something about the secret of trading, and you cut off.
The secret to life, no.
Secret of life.
I getting ready to, and I saw how I cut out. I'm not sure, because I really wasn't going to talk about Comcast or AT&T. Not sure why the computer kind of decided I had had enough. In a market that can't really determine direction, and we start to build a range. I'd love to sell premium, and what I was going to say is that with the VIX being as low as it has been, astutely pointed out, been down hovering around 10 versus hovering around 20. So it becomes a little bit more difficult, but there are high volatility stocks still out there. Look at Amazon. We can go look at Whole Foods. There's a lot of different, because those now have news. So, but they're moving. So this position is more for market that is just going to range, and we kind of are in that with our indices. Is using an iron condor. An iron condor, you just, in the old days, if you got any old option traders there, it's the box. And you just kind of like put a put spread, you sell a put spread, you sell a call spread. Lower, and you got it all boxed off. And it's a defined risk trade. And I like to sell iron condors in stocks where the volatility or the implied volatility is well above 50%. I also use probabilities, and there are really good indicators, and there's really good support that you can find that'll help you so you can determine probabilities. We've also done studies and had brought in information from other people that have created studies on when is the best time to take off a position. I know a lot of people kind of get confused. Gee, I want to hang on for that extra 50 cents in your spread. And many times it's like you'll find that taking your position off is you reach your max profit at 50% of what you think you can make. So when you're reaching that high probability, then you start to tell people or look at people to when they can receive their max profit and get that position off. But again, with an iron condor, what we're basically looking for is for it to go out worthless in all respect, because it's going to sit in the range. If you're wanting to deal with stocks that are going to range, either up or down, then Jim made some excellent recommendations on what folks can look at. I think the Mary Put is a great position for people that just need to maybe control where they're sitting with the stock. I also like verticals, and for either direction. If you think that a stock or an index has reached a pinnacle and it's now going to kind of come back, and that may take a month, it may take 2 months. So depending on your time frame, I think there's a myriad of positions that traders can use. And if someone is just basically an equity trader and they're just buying a stock and they want to hold on to it for the long haul, you can manage that position by either using calls or puts.
Okay, cool. Okay, cool. All right, Jim. I'm a little mixed up. Did we get a trade of the week from you, or?
No, we were just. I gave the strategies to take a look at and to consider, which were the ones where you put brackets around your equity.
Right.
And that was what I was talking about there. But you want to get some final thoughts here?
Well, let me get a trade of the week, and then we'll get your final thoughts.
Okay, sounds good.
As far as the trade of the week, let me get my screen shared here.
Sure.
Now, full disclosure, this is a position that did trigger into the model portfolio on, I think, Thursday. This is an IPO. The IPOs, there's been a bull market in IPOs for quite some time. And the secret, if there is a secret to them, is like what's his name? He said buy stocks that go up. If they don't go up, don't buy them. And that's Will Rogers, I believe, on that. Yeah, Will Rogers said that. Anyway, he was being facetious, but with IPOs, I'm not a huge fan of breakout trading, but you can. There are some, with a few caveats, you can trade IPOs and breakouts. One pattern I like is the first pullback after a base breakout. GOOS, more volatile stock, obviously, but it has that first pullback after base breakout. Now, it did a little bit of a fake out. It came really close to triggering, and then it barely triggered on the following day based on our parameters on a little bit of a gap. So it became a bit of a discretionary call. But above this high right here, I think it'd be worth a shot. That would be your new trigger on this one. Then you could probably trade it in more of a textbook kind of fashion with a stop pullback low, because much below this low, if it drops much below that low, you're back into the trading range. So that would be my trade of the week, GOOS as a potential long, but only above, let's just say, 23 round numbers on that one. Any closing? Let's go back to you, Jim, for your closing thoughts. Any closing thoughts and anything else you want to tell us about your trading or about OptionProfessor.com?
Well, yeah, very well. The two big things that I'm kind of looking at right now is, in my opinion, the economic numbers seem to be weakening, not strengthening. And the market in fixed income believes that the Fed's inflation fears are not real. And those are two things that are going on right now. So, optimism that we're going to re-leverage the banks and that the economy is going to be re-leveraged, and the VIX is open-endedly going to be in a complacent zone, in my view, is running out of some time. So if by the end of July, we don't see earnings really busting the door down, the economic numbers remain kind of weak, and the treasuries still keep moving towards inversion, then I think the sand may come out of the hourglass on this thing if we have not gone to 2,500 or better, and that people might not be unwise to know how to hedge or offset some of the risk in their portfolios, because the months of August, September, and October may be a lot different than we've seen in the first 6 months of the year. So that would be the further down the horizon that I would look at, because like I say, nothing lasts forever, and we have had some of these things that I just mentioned going on for quite a bit of time. So that was my final thought. And like I say, Option Professor does have 7 DVDs for educational purposes, so you guys could learn a lot more about the uses and risks of all these different tactics. And if you shoot us an email over there at optionprofessor@gmail.com, then something could be sent out to you if you'd like to take a look. And of course, as I always say, good luck to everybody and good luck on all their trading.
Thank you, Jim. Appreciate it. All right, Michael, floor is yours. Any closing thoughts or anything else you want to tell us about logicalsignals.com? Did I say Michael? Can you hear us, Michael? We lost Michael again. Okay. Well, while Michael's, I guess a squirrel got his nuts caught in the wire, was moving his nuts and got him caught in the wires between us and him. While we're waiting on Michael to wake up over there or whatever he's doing, I'll go ahead and wrap it up from my standpoint. DaveLandry.com is my website. If you have any questions on anything you heard today, or if you want any follow-up information, DaveLandry.com. Once again, kind of a long URL, and I'll clean it up a little bit on that page. But if you go to DaveLandry.com/timing-research-special offers, you can get a $100 coupon on that page, and you could get all 3 of my books and get started on the methodology. And I also do, again, weekly shows, and I'm going to take a break for a couple weeks here, but in 2 weeks I'm going to start the weekly charts again. And we have a lot of fun, and we don't take ourselves too seriously, so stop by that if you get a chance. Michael, are you back yet? Oh, we still lost Michael. Okay, well, I'll go ahead and wrap it up. If Michael comes back in, we'll let him. Suppose, Dave. Going back to you, Dave Kosmider from TimingResearch.com. Thanks once again for having me back again. And of course, Jim, thanks for being here. And if Michael comes back in, I want to thank him too. I really enjoyed today's show with you guys. What was yours? There's Michael. Michael, do you have any closing thoughts? We lost you for a second. And then when you're done, just turn it back over to David Kosmider.
Okay. My closing thoughts would be that I think that we need to just pay attention. I always start at the top of the food chain, and that is on interest rates. It's very closely, and then I just kind of move down the food chain as to how those interest rates affect our individual markets. I am very much in line with what Jim has already presented. I think that there are a lot of things that people need to pay attention to, but they need not be complacent, but there's nothing we can do about that. People are going to be complacent. People are going to be hopeful. People are going to want to believe in the best for the market because they're allowing their position to speak versus reality. And I think that's when we start to get caught in some very heavy moves because people tend to panic. So for me, I continue to believe that a lot of done when we have this false belief that nothing bad can happen. So in the tendency to, I've kind of then shifted out from carrying a position, although I still have core positions. I put it over into day trading. And I come in every day, I'm fresh, I'm new, I don't care. And that's true, you can't care. And when you kind of adopt those types of attitudes, I'm not married to what someone's earnings is going to be. I'm not married to what truly the government can or cannot do. I'm just hoping that one or the other occurs. Only because that provides the movement that we look for in the market. I base not a lot, most of my trades on volatility and probability. And so I think when you can kind of wrap some different concepts around how you want to look at a market, how you want to trade a market, I try to teach people that in what I do now is basically we're just facilitators for the movement of dollars. Because in essence, that's all that's really happening. Traders are coming in with dollars to buy or sell crude oil. They're coming in with dollars to buy or sell gold. They're coming in with dollars to buy or sell the NASDAQ. So you're just facilitating that and not really caring that, oh, well, it's this product. It's the NASDAQ crude oil. Because I couldn't tell you what the fair value of crude oil is going to be.
Oh, you can
I
tell
have no
me.
idea.
You can tell me.
And I really don't care. So I'm there for the moment, I guess you could say. And I think that there's enough to do and there's enough money to make that you're not having overnight risk. You're not having extended risk and sitting on the sideline of hope versus the sideline of action. You know, so it's that anticipation versus participation guideline that I kind of put out there.
Gotcha.
So that's
Good
how.
stuff.
Oh, and if people want to get in touch with me, please, Michael@logicalsignals.com.
All right, Dave Kosmider, back to you.
Oh, sorry, I forgot to do that.
That's okay. Kosmider's we put him to sleep over there. We should talk about him.
I know, we should.
Margin call.
We went. By the way, Jim,
All right.
thank you. I really appreciate everything you said, Jim. It's good stuff.
Oh, thank you very much. Yeah.
That's one of the complaints about the show is that we don't have enough controversy. So yet again.
I'm sorry, sorry about that too.
Well, while we're waiting on David, if he's having technical difficulties, I'm not sure or not. But obviously,
no, Dave, we can't.
TimingResearch.com is the website if you want any more information on these shows. He puts them on every week, and I'm the occasional guest host, in case you were wondering. I used to be the full-time host, but now we're mixing it up a little bit, and we have a different guest host every week, and then I'm more of a fill-in host. But anyway, you can find out more at TimingResearch.com. Thank you, Jim, Kenney, for being here, our Batho professor, and Michael. Thanks again to you, Filighera, for being here once again from Logical Signals. And I think that's it. Thank you, guys.
Okay. See you later, guys.
Okay. Bye-bye.